All right, welcome back inside our proactive newsroom. And joining me now is head of energy research for Vetify, Stacey Morris. And Stacey, good to see you. How are you?
Doing well, Steve. Thanks for having me.
Yeah, good to have you along. And energy has really lagged this year, but midstream is well up about 20%, in fact. So, can you talk to us a little bit about how midstream is a bit different than the broader energy sector?
Yeah, midstream is up, 30% in some cases, even higher. So we've seen a really strong year for the midstream space, even though your broader energy has not done very well with the volatility that we've seen in oil prices, and particularly in the US, a lot of weakness in natural gas prices. But the midstream space is different from broader energy in a number of ways. And the main, punchline there is that midstream companies are providing the shipping and handling function of the energy value chain. So they're providing services for a fee under long-term contracts, and they have a lot of visibility to their cash flows for not just this year or next year, but years to come. And so midstream is unique in that they have more stable cash flows, predictable cash flows, and they can generate free cash flow whether oil is at $60 or whether oil is at $100. So midstream has done very well this year. It's more defensive energy exposure, and it's not as tied to what's happening with oil and gas prices.
Yeah, is that's really what's driven the strength of the midstream performance, as you mentioned, just about where companies are at cash flow and things like that, or is there other things as well?
Well, so that's part of it, right? They're not as sensitive to what's going on with the weakness in oil. But it's also, companies are doing a great job executing. They're generating that free cash flow. They're returning that cash to shareholders through dividend growth and buybacks. So when you look at this space across the board, companies are generally up. We've seen good performance that's broad based. But if you dig a little deeper, the names that are really doing well are those that are focused on natural gas. So companies that are operating long haul pipelines to transport natural gas are up in some cases 40, 50%, even 60 or 80% in a few cases, just because there's been so much focus on the long-term outlook for US natural gas demand. And that picture has really strengthened this year as people are starting to factor in power demand growth, demand related to artificial intelligence and data centers. And so we see this step change in natural gas demand over the next couple of years, really benefiting the midstream space.
So you think that the positive momentum here will continue?
I do. I think it can because we're really kind of on the early cusp of this multi-year demand growth trend. And you're just now starting to see companies actually announcing projects to play into that growth opportunity. So I think it's still early innings. I think companies are going to continue to execute well in terms of generating free cash flow and returning that cash to shareholders, which has also been supportive for performance over the last couple of years. And free cash flow yields in this space remain very compelling. So even though we've seen a good run, I still think there's good momentum here.
Okay. Now, the underlying index for the Alerian Midstream Energy dividend was recently switched to another Alerian index. So, can you talk about the benefits of this particular one?
Yeah, sure. So the index now is the Alerian Midstream Energy Corporation Dividend Index, ticker AMCCD. And what's nice about this index, it's dividend weighted like the old one was, but it's a little more focused concentration on the C Corps in the midstream space. And that's positive because now the ETF can do physical replication versus swap. So you don't have to worry about a swap or a swap fee with the new index. And it's giving you more exposure to those natural gas focused C Corps that have really kind of been the leaders this year. So it's giving you more exposure to what I think is a really positive theme. And you've still got a really quality index. So about 80% of the index by weighting is investment grade. Over 80% of the index by weighting have grown their dividends within the last year. Over 70% of the index by weighting has a buyback authorization. And the yield for this index is around 5%. So still gives you your really healthy midstream exposure, but by focusing on C Corps, that's allowing for physical replication, which I think is just kind of a little more straightforward and more beneficial anyways.
Yeah, Stacey, makes a lot of sense for sure. Good to see you again. Thanks very much.
Thank you. Appreciate you having me.
All right, there's Stacey Morris. She is the head of energy research for Vetify.